Welcome to Breaking News to Trading Moves. Imagine spending $5.6 billion in cash to acquire a massive asset, and instead of throwing a parade, the market just immediately penalizes your stock.
Yeah, it's a completely counterintuitive reality.
Right. But that is exactly what is playing out for Biogen right now. They are agreeing to buy Apellis for about $5.6 billion in cash.
That is the exact headline we are evaluating today. Our objective here is to just look closely at the mechanics of this specific transaction and really understand the market psychology driving the reaction.
Exactly. So the mission for us is to lay out exactly who the market winners and losers are following this exact transaction.
Right, keeping it very factual.
Yes. Strictly sticking to what the text outlines regarding immediate market reactions and sentiment. We are avoiding any exaggeration about the broader market. I am just eager to get straight to the facts and see how traders are positioning themselves based on this cash deal.
Well, we will take a calm, analytical approach to this. Every time a premium of this size is paid, traders immediately recalculate the value of specific competitors, potential targets, and of course the buyer itself.
Absolutely.
So we will go through those groups methodically, looking at the specific reasons certain clusters of stocks are reacting to this $5.6 billion cash deal.
Perfect. So let us start with the companies immediately benefiting from the premium Biogen is paying. There is a clear group of winners here, and it begins with takeover candidates in the rare disease space.
It does. The market is very quick to identify sympathy beneficiaries.
Okay, so who exactly?
In the rare disease category, the specific beneficiaries getting a boost are Alnylam Pharmaceuticals, which trades under ALNY.
Got it.
Then there is Ultragenyx Pharmaceutical, ticker RARE, and BioCryst Pharmaceuticals, trading as BCRX.
Okay, so walk us through the specific mechanism there. Why do those three names suddenly get a boost in sentiment just because Biogen bought Apellis? They did not even make the same drugs.
No, they don't. But it comes down to how investors re-rate companies when a large premium deal occurs.
Oh, I see.
Right. When traders see a $5.6 billion cash transaction, they immediately start searching for the next possible acquisition target.
Just looking for the next one in the same space.
Exactly. They look for U.S.-listed rare disease companies that possess three main characteristics. They need approved products, a specialist commercial infrastructure, and attractive pipelines.
Let us break down those characteristics, because that is where the real value seems to be hiding.
Sure.
Having approved products is obvious, right? The regulatory hurdles are cleared. The FDA has given the green light. But that specialist commercial infrastructure, that sounds like something a larger pharmaceutical company would highly value rather than, trying to build it from scratch.
Oh, absolutely. Because building a sales and distribution network for a specialized rare disease drug is extremely expensive.
And time-consuming.
Very time-consuming. You are not just hiring people to drop off samples at a primary care clinic. You have to identify incredibly small patient populations.
Right.
You have to educate very specific medical specialists. And then you have to navigate highly complex insurance reimbursements and set up dedicated patient support programs.
So it is an entire ecosystem they have to build just to sell the drug effectively.
Precisely. That process takes years of operational heavy lifting. So if a company like the ones we just mentioned already has that infrastructure running smoothly, a buyer is not merely acquiring a chemical compound.
They are buying the whole machine.
They are acquiring a fully functional commercial engine. The market sees the premium Biogen paid for Apellis and instantly calculates that these other rare disease companies hold similar premium value simply because their engines are already built.
That makes total sense. And that concept leads perfectly into the second group of winners, which is commercial stage biotech companies with strategic assets.
Right. And here we are looking at Acadia Pharmaceuticals, ticker ACAD, Sage Therapeutics, SAGE, and Exelixis, EXEL.
So what makes these specific commercial stage companies winners right now?
Well, this deal highlights that established pharma buyers are clearly willing to pay for businesses that already possess revenue, commercial capabilities, and assets that fill growth gaps.
Favoring the proven products.
Exactly. Favoring proven products over earlier stage stories.
It's like looking at the real estate market. Buyers are currently willing to pay top dollar for a fully furnished house that they can move into tomorrow, rather than buying an empty lot and hoping to build.
That furnished house analogy captures the current market sentiment perfectly.
Yeah.
A fully furnished house generates immediate utility. In the biotech world, a company with revenue and proven products generates immediate financial returns. It completely mitigates the timeline risk associated with clinical trials.
So no waiting around.
Exactly. You do not have to worry about a phase 3 trial failing or an unexpected FDA hold. The asset is already de-risked and producing.
But I have to ask, does this specific preference for revenue-generating assets automatically put earlier-stage development companies at a disadvantage in the eyes of investors?
In the immediate term, it does put them at a disadvantage regarding takeover speculation.
Okay.
When capital is expensive and large pharma buyers are specifically targeting companies that fill immediate growth gaps, earlier stage companies look much riskier.
Because they are still just the empty lots.
Right. Investors recognize that large buyers are avoiding the empty lots right now. They are paying a premium to bypass the research and development phase entirely.
Let us pivot from those broad commercial capabilities to the exact medical specialty of the acquired company, Apellis.
Okay.
Because this brings us to another distinct group of winners based purely on the type of medicine involved.
Yes, we are looking at the ophthalmology and specialty pharma space here.
Okay, and the specific companies.
The specific companies gaining positive read-throughs are EyePoint Pharmaceuticals, ticker EYPT, Ocular Therapeutics, OCUL, and Regia XBOO, RGNX.
Now, we know Apellis brings the drug Syfov to Biogen's portfolio.
Right.
So explain why that specific drug and that deeper exposure to eye disease is moving the needle for these other U.S.-listed ophthalmology names.
Because of that specific strategic choice by Biogen, traders are paying much closer attention to these other names. Investors are calculating that larger buyers will want more exposure to retinal or specialty eye markets.
Oh, wait, let me push back slightly on that. Just because one large company wants exposure to eye disease, why does the market assume other large buyers will suddenly want the exact same thing?
It is largely a matter of competitive parity.
Oh, so.
When a major player makes a $5.6 billion entry into a specialized market like ophthalmology, it validates the revenue potential of that market.
Oh, I see.
Other large pharmaceutical companies closely monitor where their peers are placing their bets. If the retinal or specialty eye markets are viewed as the next growth frontier, maybe due to aging demographics, competing firms will feel compelled to secure their own footprint in that space.
Just to ensure they do not fall behind.
Exactly. Consequently, those specific ophthalmology companies become prime targets for investors anticipating the next move.
The market is basically playing matchmaker based on therapeutic categories. That makes perfect sense.
Yeah.
But, every acquisition comes with a price tag and execution hurdles.
Yeah.
So we need to transition the discussion from the companies gaining value to the companies facing immediate market pressure from the exact same deal.
Right, the losers in this scenario.
Exactly. Let us look at the losers, starting with the buyer itself.
We are examining the Biogen deal risk group. The specific companies taking a hit here are Biogen itself, ticker BIIB, Gilead Sciences, GILD, and Vertex Pharmaceuticals, VRTX.
Let us start with Biogen. They are the ones making the purchase. They are the ones acquiring the fully furnished house. Why are they under pressure?
Biogen faces pressure because large acquisitions raise immediate concerns about overpaying, taking on debt, and integration hurdles. A $5.6 billion cash deal depletes a massive amount of capital. Traders immediately scrutinize the balance sheet to see how this impacts their financial flexibility. And the market questions whether management is buying growth instead of delivering it organically.
Usually when you go out and buy something valuable, you look stronger. But here, the market is penalizing the buyer for the sheer cost and the execution risk.
Yeah.
Why is buying growth often viewed more skeptically by traders than delivering organic growth?
Well, delivering organic growth means a company's internal research and development pipeline is successfully producing profitable drugs.
It shows efficiency.
Exactly. It shows innovation from within the organization. But buying growth, especially at a multi-billion-dollar premium, suggests the internal pipeline might not be sufficient to meet revenue expectations.
So they have to take on immediate financial risk to compensate.
Right. And then there's the operational reality.
Right, actually absorbing another company. It is never as simple as just handing over a check and collecting the revenue.
That is the execution hurdle traders fear. Integrating an entirely separate corporate structure is notoriously difficult. You have to merge different IT systems, reconcile differing corporate cultures.
Deal with redundant personnel.
Exactly, redundant personnel in middle management and sales. The probability of friction is incredibly high, and the market price is in that potential for failure.
Which places downward pressure on the stock.
Correct.
Now, what about Gilead Sciences and Vertex Pharmaceuticals? They did not buy Apellis. They are just watching from the sidelines. Why are they feeling sympathy pressure today?
This is how market sentiment transfers among peers. When Biogen takes on this kind of deal risk, it creates sympathy pressure on other large-cap biotech names.
Guilt by association.
Exactly. Investors start scrutinizing the entire landscape, asking who else might need to do the next expensive deal.
So if traders look at Gilead or Vertex and believe their growth profiles might require a similar multi-billion-dollar acquisition in the near future, they apply the same deal risk discount to those stocks today.
That is exactly how the modeling works. The market is anticipating the future cost of doing business.
Wow.
If investors believe Vertex will eventually have to pay a massive premium to acquire a commercial stage asset, they lower their valuation of Vertex right now to account for that future capital expenditure.
They're pricing in the inevitable shopping spree before it even happens.
That is it, exactly.
That is such a vital distinction for you as you watch these large-cap tickers. The market is pricing in the potential for future expensive acquisitions.
Yes.
Which brings us to the pressures felt by competitors and other companies who might need to shop in this same, suddenly very expensive market.
Right, the competitive landscape. Let us look at the ophthalmology competition group first.
Okay.
The specific companies we are watching here are Adverum Biotechnologies, ticker ADVM, and Abeona Therapeutics, ABEO.
Why are these smaller ophthalmology players considered losers in this scenario? I mean, they're in the exact same medical field that Biogen just validated with a massive check. Shouldn't they be winners?
Well, they are losers in the specific context because the competitive environment just became overwhelmingly well-funded. When a major player like Biogen gets stronger in a specific treatment category by acquiring a company like Apellis, smaller or competing U.S.-listed names come under pressure.
Because yesterday they were competing against Apellis. Today, they're competing against Apellis backed by Biogen's resources.
That changes the entire dynamic. Traders view the competitive landscape as much tougher. Biogen has the capital to scale manufacturing instantly. They can expand sales forces across the globe and push marketing much harder than a standalone Apellis ever could.
So investors become far more selective.
Right, they become very selective about which competing pipelines actually have strong commercial potential. If a smaller company is developing a competing retinal treatment, investors have to question whether that drug can realistically capture market share against a giant like Biogen.
The perceived barrier to entry just skyrocketed.
It really did.
And this logic also applies to companies that aren't necessarily competing in ophthalmology, but who are actively looking to buy assets. Right. Let us talk about the independent biotech buyers group.
Yes. The companies listed here are Moderna, ticker mRNA, BioNTech, BNTX, and Regeneron Pharmaceuticals, REGN.
These are massively successful, well-capitalized companies. They have billions in the bank. Why is this specific transaction a negative for them?
Because this transaction reminds the market that quality biotech assets are incredibly expensive. This creates pressure on companies that investors believe will eventually need acquisitions of their own. For Moderna, BioNTech, and Regeneron, future deal-making will likely come with steep premiums and added financial risk.
It's exactly like an aggressive bidding war in a neighborhood. Once one house sells for way over the asking price, every other potential buyer gets nervous about the steep premiums they're going to have to pay to get what they want.
That mechanism is driving the order flow today. Companies like Moderna and BioNTech have substantial cash reserves from their recent commercial successes. The market knows they are looking to deploy that capital.
To diversify their pipelines.
Right. But when Biogen pays $5.6 billion for Apellis, it establishes a new, very high floor for premium commercial stage assets. Traders immediately discount the future value of the independent buyers because their inevitable shopping spree is going to be far more costly than previously modeled.
Their cash does not go as far today as it did yesterday.
Exactly.
To briefly recap the landscape for you, based on this headline, we have a clear contrast. The winners are the takeover target and ophthalmology names.
Right.
Companies in the rare disease space and commercial stage players are benefiting as investors re-rate their assets. The spotlight is also firmly on eye disease specialists as traders anticipate competitive matching. On the other side, the losers are the buyer taking on the immediate deal risk, along with large-cap peers who might face similar pressures to buy growth. And finally, the smaller competitors, plus the cash-rich independent buyers, are facing a much tougher, more expensive environment.
And I'll leave you with this final concept to mull over on your own.
Go ahead.
If paying a premium for commercial stage assets puts immediate downward pressure on a large cap buyer stock, how long can established pharmaceutical companies sustain this strategy before the market forces a change in how medical innovation is funded?
This is not financial advice or buy or sell recommendations. This is purely the opinion of the author. Thank you for your time today.